Stablecoins aren't meant to fluctuate. They're designed to stay at $1, but their supply can shrink. And if that shrinkage continues for months, that's not just a correction. That's liquidity leaving the system. Bitcoin is already down roughly 25% this year, but price volatility happens every cycle. Liquidity contraction is different. A recent Wall Street Journal report suggested that a sustained decline in stablecoins could signal something deeper than market noise. So, instead of speculating, we're testing that claim with actual data: stablecoin supply, Bitcoin's timing, on-chain activity, ETF flows, and Coinbase's exposure to stablecoin revenue. Are we seeing early cooling or the beginning of a structural freeze? Let's look at the evidence. First, let's look at the total stablecoin market cap over the past year. Throughout most of 2025, supply expanded steadily. Then, near late November to early December, it peaked. Since then, supply has declined roughly 2 to 3%. That's a pullback. But here's the key question. Is that rotation or is that exit? After a year of strong expansion, a modest contraction does not automatically signal capital flight. A true liquidity freeze would require a sustained multi-month decline. Right now, we're seeing flattening, not collapse. That distinction matters. Now, let's compare this with Bitcoin. Bitcoin started falling before the stablecoin supply peaked. That timing is important. If investors were exiting the ecosystem immediately, stablecoin supply would likely contract at the same time. Instead, supply peaked later. That suggests capital may have rotated into stablecoins first, not out of crypto entirely. Rotation and exit are not the same, and markets behave very differently depending on which one is happening. Next, network activity. Bitcoin active addresses have cooled from mid-cycle highs and gradually declined into early 2026. Participation is down for sure, but we are not seeing a collapse. A deep freeze would likely show dramatic drops in activity. What we see instead is moderation. That signals reduced momentum, not systemic failure. So far, this looks like cooling demand, not disappearance. Now let's look at institutional positioning. Spot Bitcoin ETF saw aggressive inflows during the expansion phase. Recently, flows have turned more cautious. There have been periods of outflows. Total net assets have flattened and softened. That tells us exposure is being reduced, but again, not aggressively liquidated. Institutional positioning is adjusting, not panicking. This is where things get structural. Stablecoins are no longer just trading tools. They're embedded into exchange revenue models. According to Coinbase's 2025 Form 10-K, stablecoin revenue reached approximately $1.35 billion in 2025. That's significant. If stablecoin supply contracts materially and persistently, it affects trading liquidity, network usage, exchange revenue, and broader digital asset business models. This is why stablecoin contraction matters more than price volatility. Price can recover quickly. Liquidity loss takes longer. Now let's slow down. Here's what we cannot say. We cannot say capital is exiting at scale. We cannot say contraction is accelerating. We cannot say a systemic freeze has begun. A 2-3% pullback after a year of growth does not confirm winter. It confirms softening. And markets frequently soften before either stabilizing or worsening. We don't yet have confirmation either way. So, here's the current picture. Bitcoin has corrected sharply. Stablecoin supply has flattened. ETF flows have cooled. Network activity has moderated. But none of these indicators confirms a structural deep freeze. The difference between correction and systemic shift is sustained liquidity contraction. That's the variable to monitor. Now, if stablecoin supply begins declining consistently over multiple months, that changes the conversation. Until then, this looks like cooling, not collapse. This channel focuses on verified data, not market noise.